Welcome, ladies and gentlemen. This will be the greatest video that you have ever seen on hard money loans. If you've never wanted to fix up a house to flip or fix up a house to rent for the purpose of flipping and making money or renting it out for cash flow, then skip this video. But if you're here to learn something about hard money loans, this is the video that you're going to want to pay attention to. Save it, share it with your friends. We're jumping right in. So what is a hard money loan? A hard money loan is a real estate investment tool that investors use in order to be able to buy, fix, and flip properties, as well as buy, fix up properties to rent. You get money towards the purchase price and up to 100% of the rehab budget reimbursed to you as you go through the milestones of the project. Okay, seems simple enough. You get a loan to buy a house as quick as cash in the name of your business to avoid bank delays or otherwise act with speed for an investment. Okay, that's what a hard money loan is. Traditionally, they are asset-based, meaning that it's focused on how much you're buying the house for or property for, how much you're going to put into it, what the value add will be, and then what you're going to sell it for. In this video, I'm going to break down every common question about this process so that when you go to apply for your next hard money loan or your first one, that you will be probably more informed than the loan officer or broker that you're talking to. Okay, so we outlined what a hard money loan is and why you're watching this video. Let's get into the terms. Okay, so the most important thing for a hard money loan is cash, the cost, and the exit. All right? So cash. What do you need cash for if the loan could cover everything? Are there 100% hard money loans out there where you can get 100% of funding for the purchase and rehab? Yes, there are. But most of you, if not almost 90% of you, won't qualify for that on your first flip. You will need to gain some experience in order for 100% funding to be widely available. So for a one-on-one exercise, this is pretty standard. Okay, so cash. How much cash do you need? Well, you need cash for down payment, reserves for interest payments along the way, and then to be able to fund your rehab before draws. Okay, because you're getting reimbursed on what you pay for the work. So if you're going to put $15,000 into a kitchen, then you're going to get reimbursed $15,000 for that kitchen. Make sense? Make sure that you're commenting any other questions that I don't handle in this video. Okay, next is going to be the cost. Okay, so I'm going to bend your brain a little bit and think about loans a little bit differently. Because the cost for a hard money loan is really inside of the fees. That's the cost of doing business. Okay? Fees. And that looks like points and junk. What can be in junk? Legal, processing, or really anything else. The rates, that is the price of the money. Okay? The interest rates is the price of the money. Now, what do we get on a hard money loan? Well, interest rates are higher than normal. What you will be expecting is somewhere between 9 to 13% on average for a hard money loan. You may be able to see something a little lower. You might see something a little higher. But on average, 9 to 13%. With most of the time being somewhere between 11 and 12%. What does that break down to? That breaks down to, on average, if you're at a 12% interest rate, that is 1% per month due of the loan amount. So if you have a $150,000 loan outstanding, 1% would be $1,500 a month. You're not supposed to be in these loans very long. In fact, most of them are structured for anywhere between 3 to 12 months. So if you are paying an interest rate of 12% and you're in it for 6 months, what did you actually pay? You actually paid 6% versus the 12. Make sure you put some comments on the video if you feel like you're confused. I can't go over it for you. Next is going to be your exit. Now, there is a 3-letter acronym that you're also going to want to put in the comments of what a property will be worth once it's all fixed up. Okay, it's a 3-letter acronym. Stands for what a property will be worth once it's all fixed up. Lock it in. You saved it. Great. It's the ARV, the after repair value. This is what's going to drive whether you're going to hold on to it or whether you're going to sell it. If you're going to sell it, that's a flip. If you're going to hold on to it, then that's what we call a BRRRR. That's buy, rehab, rent, refinance, and repeat. You're using the hard money loan to do the buy and the rehab portion. Once the property's rent ready, then you refinance using a DSCR loan, which I have other videos that I go into detail describing what those are. A DSCR loan to refinance, and then if you can pull cash out, then you can repeat the process. Okay? So far, we've talked about the cash, the cost, and the exit. But what we didn't talk about is what you might be able to qualify for. Everyone's got a deal. Everyone's got an individual structure to the deal. Everyone's got their own background and experience coming into it. So most likely, when you're approaching a hard money lender, they have tiers based off of credit and experience. Okay, the buckets that they're looking at are mainly for a 660 plus to 679, 680 to 699, and then 700 plus. For a hard money loan, those are the general buckets, meaning that if you have no experience at all, but you have a 660 credit score or higher, you may still qualify for a hard money loan where you'll be bearing a little down payment to close. The loan will fund the rest of the purchase price. And then as you go through the milestones of the project, you'll be reimbursed what you spend on rehab. Following along? Okay. The next tiers are going to be for experience. I'll put that over here. So experience will be 0 to 3, 3 to 4, and then 5 plus. In general, those are the categories. If you've done 10 or 15 deals, hard money might not be the tool for you right now. You should be able to raise capital for your projects. You have enough experience to go to a private lender and raise the money on your own. But hard money is still an option for you, and you might be able to get it closer to the 9% interest rate versus newbies that may be closer to the 13%. You see how that works? The credit affects the leverage, how much money you can borrow towards the total cost of the project. Purchase plus rehab, that's the total cost. You can put TC in the comments if you're understanding that purchase plus rehab is the total cost. Okay, so we've gone over the cash required, the cash for the deals, the cost of the money, and the price of the money. We've gone over the tiers for credit and the tiers for experience. We've talked about the after repair value and that affecting your exit strategy versus a sale or a refinance. If you guys would like section 201 in this course, make sure to share, like, and follow. Thank you.